Welcome to another virtual session of the A4S Summit 2022. I'm Brad Sparks, Executive Director for A4S in the United States, and I'll be moderating today's session on mapping reporting developments in the US. Like elsewhere in the world, there have been several recent sustainability-related reporting and disclosure developments over the last few years. This session will provide some insights with regard to this emerging landscape and explore opportunities for the finance community to be best prepared for the journey ahead. I'm delighted to be joined today by two prominent leaders for this discussion. Allison Heron-Lee is a former SEC acting chair and commissioner, also now serving as senior research fellow at the New York University School of Law. Mark Kaye is senior vice president and chief financial officer of Moody's Corporation. He's also a member of the U.S. chapter of the A4S CFO Leadership Network. Thank you both for joining me today. Allison, why don't we begin with you? The SEC over the last couple of years has introduced several expanded sustainability-related disclosures, from human capital to climate to cybersecurity. Can you share a little bit about what the drivers were for these enhanced disclosures in the U.S.?
Sure. I mean, I'll start first. Thank you for having me. It's lovely to be here and be part of this with Mark and with you, Brad. So really with the SEC, there's no mystery around our remit and our mission, which is to bring transparency, to bring accountability to capital markets in order to keep capital flowing where investors want it to go, price the risk accurately, allocate capital as they see fit. And what we have seen over the past, it's actually been by some measures 2 to 3 decades, but more, much more precisely in the last 5 years, a huge push in the investor community for this kind of information. Investors want it in order, as I said, to price risk accurately and to allocate the capital as they see fit, not as others may see fit, but as investors see fit. And so that's what's driving it. And that's what has driven a number. And that was true in the prior administration. You mentioned human capital. We introduced the topic of human capital in 2020. I think I've been a little bit, and as have others, disappointed in what that has produced, because it was kind of a broad, principles-based, tell us what's material about human capital. And thus far, I don't think we've seen a lot on that. So I'm thinking and hoping we may see a follow-on to that, where potentially the Commission proposes some more specific metrics there. But nevertheless, it's very clear it's just investor-driven at the SEC.
Yeah. Hey, and Mark, as a CFO, does that resonate with you? What do you see as some of the drivers for sustainability reporting in the U.S.?
Yeah. So firstly, Brad, thank you very much to yourself and A4S for hosting me today and including me in this discussion. There are several drivers that are prompting companies to address and disclose sustainability-related information. First, I'd say, is the increased accountability that's being demanded by a broad range of stakeholders. We've seen over the last several decades, investors, customers, employees, policymakers, they've increasingly focused on sustainability, and specifically the disclosure companies make around the environmental, social, or governance elements. Investors, for example, are in search of consistent and comparable quantitative and qualitative data to measure companies' ESG and climate-related risks. They also expect, by the way, the data and reporting to be accurate, reliable, and validated. And that's especially true if it's going to be used in assessing investment decisions. The second driver is the level of inconsistency in the adoption of voluntary reporting standards. For example, the majority of ESG and climate-related information that is disclosed by companies today is done so voluntarily. And so companies can decide for themselves whether, what, where, and how to disclose. And just consider the number of voluntary third-party frameworks and standards for sustainability-related reporting, including, for example, the Sustainability Accounting Standards Board, SASB, the Task Force on Climate-Related Financial Disclosures, TCFD, and even the Global Reporting Initiative, or GRI, among many others. And while all of these organizations provide valuable metrics for sustainability reporting, they vary in size, scope, and approach. And in addition, these organizations don't necessarily have the authority to require companies to consistently adhere to these reporting frameworks. And that brings me maybe to the final driver for sustainability reporting, which are the emerging global regulatory initiatives. As investors and other stakeholders demand more comprehensive information around the impact that ESG and climate risks have on their investments, regulators and policymakers around the globe, which includes the US, have developed proposals that require that material sustainability-related information be disclosed publicly in a consistent and comparable framework, with many of these proposals based on existing voluntary standards that I just mentioned.
Great. Thanks for that, Mark. I mean, I think one other thing around Moody's that's kind of interesting, right? And if you think about the use of some of this sustainability reporting and disclosure, is that Moody's incorporates these disclosures in your mainstream credit ratings. Could you share just a little bit about how those disclosures may influence a credit rating? And probably, do you think companies appreciate and realize how sustainability issues are being factored into credit ratings today?
Brad, absolutely, and that's a great question. So Moody's credit ratings seek to incorporate all factors that can be material, that are materially impactful to credit quality. And that's going to include ESG and climate risk. Our ratings also take the most forward-looking perspective that visibility into these risks and the related mitigants permits. So for example, our credit rating analysts have assigned newest ESG scores across thousands of rated entities to transparently and systematically demonstrate the impact of ESG on credit ratings to the market. And these scores include two primary components. There is an issuer profile score, we call IPS, which measures an entity's exposure to ESG-related risks and opportunities that could be material to credit risk. And then there is a credit impact score, which we call CIS, which captures the impact of ESG factors on an issuer or transaction-related credit rating. Now, both scores are designed to be comparable across sectors, geographies, asset classes, which really is meant to enable easy issuer comparisons and tracking. And that's especially important when managing credit portfolios exposed to multiple ESG risks. We pair our systematic approach here to ESG with transparency in our communication, and that's an important topic and point here, because, for example, our credit opinions and press releases provide information on the ESG factors that were or are considered material drivers during the ratings process itself. So the question is, what does the distribution of the scores look like today? And what do they mean for the company? And we see here that, you know, the scores across E, S, and G are at least highly negative drivers of credit quality for about 23% of the approximately 5,700 issuers that Moody's had scored through the end of September. So in other words, almost 1 in 4 credit ratings would be higher were it not for the impact of those ES or G considerations. On the other hand, ESG constitutes a positive driver, I'd say, for just 4% of rated issuers, mainly governments in advanced economies, as well as select financial institutions or corporates. And then within the ESG category, governance considerations themselves tend to be the primary driver, both positively and negatively. So nearly all entities for which the credit impact of ESG considerations is positive have relative governance strengths, while I'd say 90% of entities for which the credit impact is at least highly negative have relative governance weaknesses. So hopefully that gives you just a feel for how the credit impacts are impacted by ESG.
Yeah, no, really interesting. And I think, you know, thinking of those material issues for companies and that impact is where this, you know, really is probably most and best understood and appreciated. And I think all material issues, certainly climate-related risk and opportunities, are a material issue for many companies. Allison, one of the most significant developments by the SEC over the last year has been the issuance of the proposal to enhance and standardize climate-related disclosures for investors. I think at the last count that I saw, there were somewhere north of 15,000 comments since that proposal was issued earlier this year. And I know many of these responses came from a variety of stakeholders, but I'm particularly interested in the views of investors, given kind of what you mentioned at the drivers of reporting. So what did investors like about the proposals, and what areas did they have some concerns?
Sure. I will say that you mentioned that the comment letters that we got after, or they got, let me get my pronouns right here, that they got after the proposal. We also, of course, had thousands of letters before the proposal, because I had put out a request prior to try to inform even the proposal with the public's views. And I think that actually advanced the ball quite a bit, because it really helped us understand the various segments in the market and how they were going to come at it. And hopefully we will have short-circuited some of the issues we might have otherwise hit. But in terms of what investors liked in the proposal, I think they particularly, they were very clear that we need some baseline metrics, because comparability is like, consistency and comparability, two extremely important concepts. And so they were very clear they wanted emissions data, and not just any metric, but emissions data. And they were very clear that they would like information on the current financial impacts to the to the financial statements, in a way that the FASB, I think frankly hasn't quite caught up yet, to help make sure that we're really incorporating some of the longer term asset valuations, a number of other issues. And so those 2 points, I think, were quite important to investors. They had a range of approaches they, I think, supported. But, I do think, and a third piece, I think they all thought was very important, or most of them, there's no uniform view of, from any group, though, was leveraging the work that's been done already in the markets and not creating something out of whole cloth. So I would say maybe those 3 things were what we heard most from investors about a proposal. Now, areas where they had concerns, since the proposal has come out, they now have something to actually, sort of comment on and the like. And there have been a few. And one of them, I think there was some real concern over how we dealt with scope 3 from the investor community. I think there was a concern that perhaps leaving it to materiality determinations on an individual basis by management at each firm was potentially problematic. And I think they would have liked to have seen more of a bright line. Many of them would have liked to have seen more of a bright line threshold there. In addition, as I mentioned, consistency and comparability are important, but also reliability. And and you probably know, the one place where we did not impose any kind of a requirement for verification or third-party verification is on scope 3. And given the significance of scope 3 and the fact that, when you look at the major global emitters, most of their emissions are scope 3 emissions. I think there was some concern about whether we should have had something, maybe not on day one, but down the road, something that would have incorporated. And that's not precluded, but that's, the proposal doesn't have that in there. And I think that was a concern as well.
Yeah. Okay. Yeah, thanks for that. And on that issue of your data quality, data reliability that you just referenced, I wonder, Mark, if we maybe move to you and talk about one of the most frequent challenges cited by the CFOs that we work with in regard to sustainability reporting across all types of information is that data quality and data availability, right? So how at Moody's have you addressed this challenge of getting high quality information, reliable information in a timely manner?
Yeah, so ESG data quality and availability is indeed a recurring theme. And we're seeing this as the market continues to drive increasing demand for ESG related data and analytics and insights. Given the nascent global ESG and climate related regulatory reporting and stress testing requirements, Moody's customers, including banks, insurers, investors, and corporates, have an immediate need, to your point, to understand and manage those underlying ESG trends. And as such, they are seeking cohesive ESG data sets for a global universe of companies, but they're similarly faced with challenges in addressing information gaps and disparities. So at Moody's, our team first gathers all publicly available ESG data, to which we then apply quantitative metrics to assess ESG risks and opportunities. And although our base assessment is informed by metrics, the ultimate sector category and issuer profile scores are substantially driven by our qualitative assessments of the risks or benefits and some of the ESG specific mitigants that are unique to each sector and issuer. Furthermore, we are able to inform and supplement our work through information that is gained via direct engagement with the issuers, which enables us to have greater visibility into certain elements than maybe what is publicly available. Where we still have data gaps, we have developed a number of proprietary machine learning and artificial intelligence models to assist us in creating proxy detail for some of that missing information. And that's going to include, for example, what Alison spoke about, estimates of greenhouse gas emissions for scope 3, especially for non-reporting small or medium-sized enterprises. And then finally, we are able to bring this all together for, again, the benefit of the customer using our ESG score predictor solution, which generates modeled ESG scores based on both the unique sector and issuer data and on our historical in-depth ESG analysis of over a little over 5,000 global companies and their associated scores. And to close out the answer, I think the most important point here is that the perspective is for corporates ultimately to disclose ESG data that is in line with reporting guidelines, whether they are voluntary or mandatory, as that is going to ultimately lead to improvement in the standardization set available for financial and non-financial analysis.
Yeah, thanks for that overview, Mark. I mean, I think, as you think about getting that ESG data and now the finance and accounting team becoming much more involved in that process, it's interesting to see how different finance teams are organizing themselves around this. And so I know at Moody's, I think y'all recently appointed an ESG controller on your team. That's a new position that we're seeing other companies develop as well. Could you just talk a little bit about what prompted that particular decision and how you envision that it will help you actually provide more efficient and effective disclosure going forward?
Yeah. That's a great question, Brad, and thank you so much for asking. So we have recently appointed an ESG controller who reports into our chief accounting officer, and she works closely with the Moody's sustainability and government and regulatory affairs teams on new and emerging global regulatory reporting requirements and disclosures, as well as the underlying control framework. And this decision, to your point, was really prompted in part by our evaluation of the external operating environment and how it's developing. With several emerging ESG-related regulations, reporting standards, as a company, we thought it prudent to prepare for those likely requirements. And that's similar to the actions that we believe are now being taken actually by many other companies. And within the finance organization, that means we need to strengthen our capabilities and skill sets to address these anticipated reporting obligations. So maybe just let me provide a couple quick examples. So here in the US, the SEC has proposed new rules requiring certain climate-related disclosures for public companies, and that includes a company's own greenhouse gas emissions and how they're managing climate risk. Separately in the EU, we've just seen the adoption now of the Corporate Sustainability Reporting Directive. And that's going to significantly broaden the scope of the existing sustainability reporting requirements for EU companies, as well as sort of non-EU companies with significant EU operations and subsidiaries. And Moody's supports these regulatory initiatives as they represent, a growing, to what we've spoken about previously, stakeholder focus on having consistent, comparable, decision-useful sustainability information. Furthermore, within Moody's, under the leadership of our executive team and our board of directors, finance works together with our business partners across the organization to make ESG and sustainability core parts of our corporate purpose, which really means a core part of our product offerings and ultimately our culture, meaning we really want to embed sustainability into our corporate DNA. And that's important because we're committed as a company to making sustainability foundational to our business. And in doing so, hope to be able to contribute to the collective effort of stakeholders to create ultimately a more sustainable and inclusive financial market.
Great. I think it's a great example of how, how to address this from an organizational structure and what to consider and navigating that evolving global landscape, I think is also very important. And you referenced, some of the emerging regulations from the EU that will impact US companies. Allison, many large US companies are going to be impacted by these emerging standards around the world. And most of the CFOs that we work with, feel strongly that there's real need for alignment to really enable both effective and efficient reporting. To what extent did the SEC really consider some of the global developments in reporting when drafting the climate-related disclosure proposal in particular?
Well, rather than speak for the SEC, I will speak for myself because I was there at the time when we put out the proposal. And I can tell you that my own personal view, and it was shared by many, some of my colleagues, many on the staff, was that it was paramount to have as much alignment as we could. And I mean, in my own view, I immediately, when I became the acting chair, began those conversations internationally, bilaterally, multilaterally, had them, several times a week, because it seems very clear to me it's not just that it's important from the standpoint of U.S. global corporations, but it's also important because this is a global issue. We are dealing with a global problem. Nobody is exempt from it. And we have a growing global economy. So, to me, the alignment was very important. I can tell you how that was reflected in the proposal, and we'll see sort of what happens at final. But part of what we were thinking was we will leverage these existing solutions. We will leverage the TCFD work, which I think has just been phenomenally well done and broadly accepted. We leverage the greenhouse gas protocol, which again, I think is a pretty good standard for how to go about measuring emissions. And so, it's very clear that each individual jurisdiction around the world, especially the sort of ones that are, bigger pieces of the global economy, have to tailor the rules in a way that will fit their own unique sort of demands based on their laws, based on geopolitics, based on a number of other things. But my view was a baseline. We need a baseline globally, not a buffet, but a baseline, and then let jurisdictions build from there, which I think we did do, because as you know, we did adopt, broadly speaking, the TCFD framework, but we put our own sort of spin on where we thought it was important for US companies to talk at a more granular level about things like risk and the like. So I think alignment was and remains one of the most critical pieces here. And it's also one of the most complex to sort of deal with and negotiate, and we'll see where they land, but I do think it is in their minds. It certainly was in mind.
Yeah, it's definitely complex for sure. I mean, Mark, as CFO, do you think we're on the right path for global alignment? What maybe causes you concern about current developments and where we are today?
Yeah, so I know I probably mentioned this previously, but it's just worth bearing. Moody's really supports the international alignment of reporting standards, and this is because globally consistent and comparable sustainability disclosures, they are necessary if we're going to enable investors to make informed decisions around the impact that, for example, climate-related risks have on their investment portfolios. We are hopeful that regulators in different jurisdictions will work together to develop a set of interoperable international standards with the flexibility that allows also individual jurisdictions to complement those standards with incremental disclosures that may be relevant to the jurisdiction's specific objective and use cases. One example of a developing country-specific standard is the SEC's climate-related disclosure proposal for the US. And earlier this year, Moody's submitted a comment letter to the SEC where we expressed support for the Commission's efforts to align its proposed climate disclosure rules with the framework developed by the TCFD, as well as the GHG protocol, both of which are endorsed standards in the US and globally. And we welcome the Commission's efforts to cooperate with the ISSB in the future development of a global set of standards to complement and augment the work that is already going forward. Additionally, as a company, we have supported the work of the ISSB to develop the core sustainability disclosures that could be used by any global jurisdiction that signs on to implement them. And we are encouraged that there is a good deal of support internationally for this approach. The caveat, of course, as you well know, Brad, is that in practice, this adoption is not so simple. And that's driven in part by the fact that there are noticeable or notable differences in emergent reporting frameworks and scopes. We still have a ways to go, but I think overall regulators and standard setters, maybe, for example, the European Financial Reporting Advisory Group and the ISSB, they've shown really positive signs of working towards that interoperability and that harmonization of the global sustainability framework.
Great. Thanks for that, Mark. Maybe one question for both of you, and that's something that I've heard from quite a few people is that there is this concern as things get regulated and required reporting goes forward that sustainability reporting could morph towards a tick box exercise, right? And that it starts to produce information that's being disclosed and that may not be decision useful. I guess from your own perspectives, what do the people that we work with, CFOs, investors, others in the finance community, need to do today to make sure we remain on a pathway that will produce decision useful information around sustainability? Mark, maybe we could go to you first.
Sure. Brad, we agree that more work needs to be done to make the reporting of sustainability-related information decision useful. There are significant signs of positive progress around climate risk disclosures, but clearly there remains room for enhanced reporting to fully assess companies' overall sustainability performance and preparedness for this transition to net zero. I know, as we've discussed this morning, a mandatory regulatory reporting framework for sustainability disclosures is what we think of as a necessary condition to ensure consistency and comparability. Of similar importance, I would say, is incorporating sustainability into a company's corporate strategy where it's material and relevant, and then have the subsequent disclosures to be around that demonstrated progress. In the end, our recommendation is not to simply present ESG metrics absent any context in the hope that those metrics are going to speak for themselves. Specifically, we need to, I'd say, first accurately quantify the business value of sustainability initiatives, i.e. clarify how ESG issues are going to impact revenue, operating expenses, as well as other key line items and drivers. Second, I would say, is to report consistent metrics every year. So that's going to help stakeholders sort of assess trends in the organization's ESG progress or lack thereof. Use factual, objective language here. Third, I would say, is to present both favorable and unfavorable metrics. Transparency is important. Building up that credibility with your investor base and your customers is very important. Fourth, I would say, is to report the steps that the organization is taking to mitigate identified ESG shortfalls. And then finally, a couple of metrics with illustrative examples and explanations that connect sort of the data to the strategies is incredibly helpful. And to close out here, obtaining that third-party independent assurance is certainly one way to provide those stakeholders with more confidence, again, in that accuracy, that validity, and even the reliability of data that's going to underlie those disclosures.
Great, some great practical advice. Allison, additional thoughts from you on this question?
Sure. First of all, let me just say I agree with everything Mark just said. From the SEC's perspective, in the proposal, we're fully aware of the danger of companies kind of lapsing into some boilerplate type disclosures. That's common phenomena. It's understandable. I know why it happens, but it's not necessarily useful. And so, for example, instead of just saying, tell us what's material about this, or risk factors are a prime example of a place where you get a lot of boilerplate. And there's a huge incentive for companies to put as much into those risk factors, because those they can point to later if and when they end up, in some kind of litigation or the like. So those, I think we really wanted to avoid seeing companies kind of gather around some agreed language that everybody would just start to say and leave it at that. And that's why the metrics were so important. That's why it was important to have some measurable, verifiable, consistent from period to period information like emissions, and very importantly, like the financial statement piece, right? That piece is the piece where you can, if it gets finalized with that in there, investors will be able to watch the trend lines of how those, how the financials are impacted currently right now. They'll see it quarter to quarter, or at least year after year. They'll see, okay, here's a place where impacts have exceeded 1%, or possibly capital expenditures have exceeded 1% by X amount. The next year they can see which direction it's going. I think that piece, is very important. And also, it's the opposite of a tick box exercise. That is an intense, important exercise that needs to be pulled into, and will have to be if it becomes finalized, into the fully into the 404, the Sarbanes-Oxley protections, all of that. And I think that's an important way of ensuring that we actually get uniquely important, but consistent and comparable, reliable data out of this rule.
Great. Well, one final question for each of you as we go into the next reporting season. Any advice or top tip for preparers as they think about their future disclosures? Allison, maybe to you first.
Sure, a couple of things. I think companies, first and foremost, in the absence of any in the U.S. anyway, of more specific requirements, should start by thinking very carefully about what they're choosing to say right now. They're choosing to do it, but that's not a free pass. You need to make sure that you're comfortable, that you've made the right choices, first of all, about what you want to say, and then secondly, that you back it up, that it's accurate. And so, just like with any kind of issue inside of a corporation, you hire an expert. You need experts. You need people who know what they're doing here. Now, I'm not saying where. It can be at the C-suite level, maybe it's below, maybe it's at the board level. That is a unique decision, on a company by company basis, but you need that expertise. I would focus, if it were me, I would focus first on what we're choosing to say now and making sure that I'm comfortable with that. And I think secondarily, and almost just as important, be preparing for what's potentially coming down the road, and ask yourself, if that rule is finalized tomorrow, where are we in terms of our journey to get to the place we need to be, and start preparing now, because it's not, it's not going to be a simple, easy transition. And companies should start now, sooner rather than later, in my view.
Right, and Mark.
Yep, and full recognition of some of my comments earlier, and fully supportive of Allison's remarks, and also maybe recognizing that it's not a question of whether companies will be required to incorporate ESG into the regulatory reporting, but rather when those standards are going to take effect and what metrics would be required. Maybe I can add two more additional pieces. First, understand which topics are the most important to your stakeholders. I'd recommend a materiality assessment or other similar exercise to sort of gather that information. And secondly, take proactively the steps that you need to be prepared for when the reporting regulations are finalized. So for example, collect data internally, develop those internal disclosure controls, make sure that you're being complete and accurate in the information that you want to put out there. And then finally, consider what processes you need to take to establish ultimately for an independent assurance, support and service, and even audit of the ESG and climate related data information.
Great. Well, thank you so much to Allison and to Mark for sharing your perspective and really helping us better understand and prepare for this evolving landscape, both globally and within the US. So really appreciate your time and insights today. The A4S Summit 2022 continues with another session later today, hosted by one of our partners, IFAC. They'll be providing a global view of corporate disclosures. So please stay tuned and participate in that session as well. We'll then continue over the next 2 days with the focus on people, planet, and nature, with the focus on finding solutions to that which threatens each of those. And that will include 2 sessions that will be live streamed on Thursday from Mansion House in London. Finally, to learn more about reporting developments and to gain insights specifically targeted for the finance community, I encourage you to check out our sustainability-related reporting resources, all of those available at a4s.org. Thanks again for joining, and good day. Thank you.